The G20 has been the core crisis committee in the wake of recent global economic uncertainty. Among its first tasks was to tighten the rules and enforcement of national and international financial regulation. In this third video, we've asked participants of the CIGI-Chatham House workshop on global economic governance in the world of crisis to respond to what the G20 has done in this area and what tasks remain to avoid future crises.
One of the main conclusions was a bit of a surprise to us. If you'd said we would conclude that if you'd said that at the beginning, we wouldn't have been so sure about that. But one of our conclusions is that although much of the talk is global, the idea of having a single set of global rules enforced by a home regulator is going to be very hard to get right. And that we're going to see an increasing amount of regional action and national action. We fundamentally believe that what was mainly the main failings of regulation was the macroprudential side. Yes, we can improve the microprudential, but crashes, financial crashes are not random. They always follow booms. And we need to address the booms if we're going to solve the crashes or mitigate or minimize crashes. And the way you solve the booms is by having more macroprudential, tighter macroprudential regulation. Things like higher capital charges that rise as the boom progresses and falls back as the crash arrives. I think we have moved towards a more legitimate global governance, more accountable. Whether that will solve the problems we're facing is almost a separate issue. But one of the problems of the boom and the crash was a sense that the international organizations were illegitimate. And this led to a greater reliance on self-insurance, a greater willingness to go their own way in terms of countries. Right. And so maybe if we made our institutions more legitimate, we may have reduced that problem.
Yeah, it's actually a good example of this kind of incremental change, because there was a body set up after the East Asian crisis called the Financial Stability Forum. And it was set up at that time essentially as a way to coordinate what is a very complicated set of international agencies, national authorities, regulatory authorities, to try to think of ways in which all of those officials could be anticipating and preventing future crises. Obviously, they didn't succeed. We've just lived through one of the worst crises since the 1930s, and so one of the first things the G20 did was to try to strengthen what was an existing institution, and they strengthened it in a number of ways. One was to expand the membership. It was really a club of rich countries, and that really was not the best way to have an organization, especially in a context where some of the new centers of wealth had moved to countries like China and Brazil and India. And so there's a rapid expansion of the membership, but then an attempt to strengthen the institutional foundation of what had essentially just been a kind of a network-based organization. So it now has a secretariat, a strengthened secretariat. It's got binding commitments that members must uphold, and a bit of a strengthened apparatus. It's still a weak institution. Tim Geithner, the U.S. Treasury Secretary, has referred to it as the fourth pillar of the Bretton Woods system. If it is the fourth pillar, it's a very different organization. The IMF and the World Bank and the WTO, the other three pillars, have very large staffs, all kinds of power. The FSB doesn't have any of that. It has about 14 staff at the moment, and essentially is a way of coordinating the activities of national and authorities. And so one of the things that we're trying to understand about the FSB is whether, in fact, it can live up to the expectations that have been put on it in light of these recent reforms, and that really we'll have to wait and see.
Well, I think we have to look at this on two issues. The first one is about the source of crisis. It is true, it came from the lack of the regulation in the US. But in addition to that, it's also facilitated by some issues related to the Asian countries as well, which is the global imbalances. So it doesn't mean that Asia is completely, not responsible for that one. So this is the way we look at this crisis. It needs a global solution for that one. It should be the multilateral solution. So I don't think it is, wise to look at this crisis as only the crisis of the developed economies, not the Asian countries, because eventually the Asian countries also affected by this one. And when you're talking about this policy coordination, you have to include the Asian countries as well to do the counter-cyclical policy. Otherwise, this counter-cyclical policy will not work effectively. Right. And I think that's also one of the reasons why this policy coordination with involved the Asian countries become very important. Right. So look at from this perspective, I do believe that a better cooperation, enhance this cooperation will sort of like provide hopefully a clear solution for this global crisis.
Well, I don't know if I agree entirely with your definition of a big innovation. It's probably, as we repeatedly said during our workshop, that G20 is a process, and probably it should be a process, and it's a forum, and again we discuss a lens of effectiveness versus legitimacy and that kind of issues. So this is, I do not see the G20 as itself an innovation, but it certainly was a big step, and it was a big step because the crisis somehow focused everybody's mind on what needed to be done. And again, I think from my view, what was the big achievement, certainly of the G20 in London, was to show that somebody was in charge and therefore boost confidence, because that was the main critical issue at that time. Now, the point here is whether the G20 can continue, can remain, they can keep the momentum now that we are not diving together anymore, and actually the recovery can be and is taking different paths, and that could create some tensions or different set of goals and priorities.
There is an easy conclusion that politicians and voters arrive at, that financial crashes are caused by bad bankers selling bad products under bad jurisdictions. One of the reasons why it's easy is you can blame someone else, as opposed to your local regulators. And especially if these bad bankers are foreign, that's even better for the local electorate to really grab hold of. The reality is that crashes repeat themselves. We've had over 80 major international financial crashes going back to our records. And that suggests, therefore, it's not about specific products, because the products that occurred today were not around in the last 2 or 3 crashes. And so we need to think a lot more about the systemic vulnerability of the financial system rather than specific products or even specific institutions.